Hello, chart watchers, and welcome to this Wednesday, December 19th Market Watchers Live show with your hosts, Tom Boley and Erin Swinlin. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, it is Fed Day. We will be hearing from Fed Chair Jerome Powell in about 2 hours. And currently, we've got the Dow Jones Industrial Average rallying up 231 points, the S&P 500 up 24, the Nasdaq up 64, and the Russell 2000 rising 9 points. 10-year Treasury yield continues to be under pressure, though, as we see money rotating into the defensive Treasury market. Volatility index coming down after actually breaking out to its highest close since February, with the VIX closing above 25, I think it was 25.60 or so yesterday. Today, though, it is down 6%, that reduction in volatility allowing the market indices to move a bit higher. Materials leading to the upside, up about 1.4%. Energy also performing well today after getting trounced over the course of the first couple weeks here in December and really since back in October. Discretionary stocks performing very well today as well. So those are three of your leaders. The dollar index, since posting that black candle and that island reversal with a negative divergence in play, we've been seeing the dollar falling, and that is helping the material group here bounce off of price support. A couple of earnings reports out last night. Fedex Corp, not good. Big move down. They delivered, no pun intended, some bad news. And then there was Micron coming in after the bell, also posting some not so good results. Gapping down, but at least rallying back off of that earlier low. All right, Erin, it is hump day, middle of the week. We got the Fed coming up at 2 o'clock. It is exciting. Who knows where this market's going to go, but I think the market has been sending the Fed a message, and we're going to find out whether or not the Fed is listening.
Yes, indeed. And I know you and I were talking before the show about the possibility of a relief rally, and I can tell you, I know you agree, we need some relief.
Yeah, we need some relief, and some of the economically sensitive or economic sensitive areas of the market, especially the banks, getting hit really hard with the 10-year Treasury yield dropping so much, and it's an indication that their net interest margin is going to be squeezing. And it's probably, I think we're going to see some warnings out of the banks prior to their January reports that come out. At least that's what the bank index has been telling me. So I don't know. It's going to be a pretty interesting day. But adding to the interesting feature of today's show, we've got Danielle Shay in today. She's going to talk some options. I was just thinking about it. I don't think we've had anyone on here talking options.
No, and I know we don't. So
yeah. So good morning, Danielle. How are you doing today?
I'm doing great. How are you?
I am doing very well. And you are in Austin, Texas today, correct?
Yes, that's correct.
Beautiful place. Every time I look to see, all right, where do I want to retire? And I start looking at these different places. Austin, Texas is always right on the top of the list. So I'm envious. I've never even been there, but I'm envious that you're living in Austin, Texas.
Well, you should definitely come. I absolutely love it here. The weather is beautiful the majority of the year. It gets a little bit hot in August, but for the most part, it's pretty sunny and nice, low cost of living, and the people are very fantastic.
All right. One follow-up question on that. Are the golf courses nice?
I've heard that they are. I haven't been to one, but I have heard that they are.
All right. Well, I'm moving then. Anyhow, you're going to be on with us. I know you've got a presentation all set up for everybody on options, so we're looking forward to that. If you could just hang around maybe about 15 minutes or so, we'll bring you back in.
Okay, great. Thank you.
All right. All right, Erin, lots to do. And again, we got that Fed meeting coming up this afternoon, the announcement. This is going to be a crazy afternoon, but what do we got?
All right. Well, this week we've got Julius de Kempenaar. He's coming tomorrow to visit us, Mr. RRG. And then Friday, Mary Ellen McGonigal will be here to co-host and do her What's Hot, What's Not. And then I'm sorry to say, there will be no live shows between December 22nd and January 1st. So you'll just have to hang tight and have a good holiday like we hope to. Today's agenda, we're going to start off obviously with technical news, but then Danielle is going to go through when the switch happens. So this should be interesting. 10 and 10, our first symbol is going to be Wheaton Precious Metals, WPM. And finally, we'll finish off with some sector rotation information. All right, technical news and headlines. I know we got a lot.
Yeah, let's start it off with the economic reports. There was just one today at 10 a.m. Eastern Standard Time. November existing home sales came out better than expected, 5,320,000 units. Market looking for 5,190,000 units. So we did get a good report there in the home construction area, housing. Those reports have been mixed. The group's been trying to put in a bottom. This report I don't believe will hurt. But let's take a look and see what's going on in the Treasury market. So far today, we are moving lower. You can see the 10-year Treasury yield now down to 2.81%, actually just slightly below. And you can see that's below the double bottom that we saw back earlier in the year in July and August. And now looks like target set on the two prior lows, which would be at around 2.75% in May. And then at the beginning of April, we were all the way down at 2.72% or so. This, to me, is one of the problems in the market. I know, and we've talked about this before, but when the 10-year Treasury yield broke out, there were a lot of market pundits that were talking about higher interest rates being a problem for the market. But I think this is a much bigger problem for the equity market. When we see the yields dropping like this, a couple of problems. Number one, money is rotating into defensive areas like treasuries. And so the fact that we've got money rotating into defense generally is not good for the overall market. This decline also comes with an increase in the volatility index. And when the volatility index is on the rise, that is typically associated with stock market weakness. So we've got both of those going on. But the big problem when you see money rotating into treasuries is that the outlook going forward can't be great if money is rotating into treasuries and away from equities. So this afternoon, 2 o'clock Eastern, when we do get word from the Fed, it's going to be interesting to see. I think that there's going to be an acknowledgement that things are not as robust as maybe they had previously thought. But the real question is, what are they going to do with interest rates in 2019? Are they going to back off of what they've been saying, which are, a few rate hikes? Are they going to say that we're more data dependent, which I think the market, at least temporarily, would like to see? I think if they come through for the market, I believe we might get a short-term rally in equities. I'm just not convinced with all of this money rotating into treasuries whether it will last, though. So a lot to take a look at there. Let's move on. First, we've got earnings. Let's bring up the earnings slide first, and we'll take a look at those. You've got Fedex, which did miss estimates according to Zacks. Now, I looked on briefing.com, and they actually showed that FedEx beat. So I guess it depends on which estimate you're using. But they did come in $4.03. I'm showing the estimate at $4.05, a slight miss. You can see the other four on your screen, Micron, Jabil, Paychex, and General Mills, all beat expectations on the bottom line, but not necessarily on the top line, and we'll get into those in just a minute. Let's go back over, take a look at this FedEx chart. And you can see on a relative basis, things not looking so good. It was interesting because yesterday at this time, we were talking about FedEx and talking about how the technicals were aligning for a not so good report today. And that's exactly what Erin was discussing in her workshop, the basics of technical analysis and using price action to forecast a future event. Let's take a look at, or let's take a listen to that clip from yesterday. A couple companies reporting after the bell today. FDX, this is FedEx. Look at what's been going on in transportation stocks, these transportation services, freight companies. FedEx not performing well. I don't know what's going to happen with their last quarter, but I have a feeling that their guidance is not going to be very good based on what we are seeing here with all of this heavy volume selling. Okay, so as we're looking at this FedEx chart, you just listened to the clip. That was yesterday before the earnings came out. What we talked about is it's hard to say exactly what the prior quarter might be, but when you're seeing this kind of selling and folks rushing for the exits, that is generally not a very good sign about the guidance going forward. FedEx actually beat on their top line, $17.8 billion versus $17.62 billion. As I said earlier, they did miss, according to Zacks, on their bottom line, 403 versus 405. But the real problem here was that they lowered their fiscal year 19 earnings per share guidance, and then they rescinded their fiscal year 20 profit target. Now, you might have some folks who are fundamentalists sitting back and saying, wow, I didn't see that one coming. But technicians, as Erin very eloquently pointed out yesterday, we use this price action to make these kinds of predictions that are not always going to come true. but many times they will give you a leg up on those who are waiting for the news. A lot of times you can see the news before it ever even happens. And I think Fedex was a really good example of that. Let's take a look at Micron. Micron also reported yesterday and also mentioned during the show yesterday that had not been performing very well. And you can see on the chart, here's Micron's performance. And then here's the performance of the semiconductors. And then this is Micron relative to the semiconductors. So what this is telling you, first of all, is that semiconductors have not been performing very well. And when we go down here, you can see that since June, the semiconductors have been underperforming the S&P 500. So you've got a group that's underperforming the S&P 500, and then you've got a stock that's underperforming that group, its peers. So what that normally leads to is not very good stuff. They came out with their earnings report last night. They missed on their top line, $7.91 billion versus $7.99 billion. The earnings per share came in $2.97 versus $2.93, but they came out and they said, we're seeing weakening demand from our customers, which will lower CapEx spending meaningfully in 2019. Now here I'm seeing a reversal, a possible reversal off of the gap down. This could be an exhaustive gap, a lot of volume coming in. There was a lot of already bad news built into this chart. And so Micron maybe is putting in a bottom. We'll have to see how it trades in the coming days and weeks. But so far today, we are getting a rally off of that gap down today, which maybe the worst is in. Still a little too early to tell. A couple other earnings reports. JBL reported big beat on the top line, $6.5 billion versus $6.1 billion expected. Big beat on the bottom line, 90 cents versus 85 cents. Gap up, but since then you can see this black candle suggesting that the current price is below the open. Let's see whether or not we can hold that 20-day moving average. That would be the first technical step that would be positive. We'll just have to wait to see if we can hold. Next chart up is Paychex. They reported this morning, missed on the top line, beat on the bottom line, and you can see that Paychex just kind of in a range right now. The stock is up nicely, 2.9% today, but after setting a high at around $75 in October, the reaction low came down just below 63 at the end of the month, end of October, and now we're kind of in the middle. So I don't really have any strong feelings on Paychex at this point. General Mills, this is a consumer staple company. You can see moving down into its earnings. They did beat on their bottom line, but they missed their top line. And I don't like this failure at the 20-day because if we annotated, you'd see a support line coming across here at $40. We tried to move above both that and the 20-day earlier today and then move lower. The volume we've seen over the past month or so, pretty heavy to the downside. I think this is indicative of distribution in the stock. So I think this move back to the upside is not likely to last. I think we will probably be back filling that gap sooner rather than later. As far as some of the other areas of the market to pay attention to, talked earlier about the banks. I got to pull the bank index up here. Actually, don't need it on a relative chart. But what you can see is the banks completely breaking down. I did talk about this in my blog this morning. I think what we could see with the Fed coming up is just simply a relief rally after the Fed's done today. I don't know that the Fed's going to have any magic words to help banks going forward, but I think it's the group has been selling off so hard leading up to this announcement. I wouldn't be surprised to see perhaps a bottom in the short-term set and maybe a move back up to either test that declining 20-day moving average, maybe even the breakdown area around 420 from current price levels. That would be another 26 points, which would be about 6%. I certainly wouldn't rule that out. But if we get back up to that level, I'd be very, very careful on the banks. I think they could roll over and perhaps move lower, depending again on some of what the Fed has to say this afternoon. Let's take a look at the two stocks that actually announced a merger earlier. Let's take a look very quickly at GSK and Pfizer, PFE. So this is GlaxoSmithKline. You can see a gap up. The two companies announced a merger to combine their consumer health businesses into a new joint venture. Glaxo will be 68% owner of this new venture. Pfizer will be 32% owner. You can see a big move here on Glaxo gapping up. Long term, though, I don't really know that this is going to make any big difference. I think we just simply sideways consolidate. And actually, if we close back below the 20-day, it would suggest to me maybe we're going to head back down, test those earlier lows. Pfizer, on the other hand, saw much less of a response. It is up less than 1% today, but it's got some pretty big support around $41.5, $42. I would be looking for that to hold. One last final story. Eli Lilly did, I believe, increase their guidance. I'm not positive whether it was the earnings per share or whether it was revenues, but they did increase their guidance. They have held support. And this is a stock that when you look at on a relative basis, this has been one of the leaders. Here's your pharmas. Here's Eli Lilly. You can see it is breaking out on a relative basis. So it's been one of the stronger pharmas. And pharmas have been outperforming the S&P 500. So when you're looking for areas to think about investing, these are the types of stocks. They're defensive. But in this environment, I think that probably makes a lot of sense. Erin, I know you've got some upgrades, downgrades. What do you have for us today?
All right, let's take a peek. All right, actually, there were a ton of upgrades and downgrades, so I'm only going to go through a few because that's what we have time for. Okay, here we go. So our first one I'm going to look at, this is an upgrade. Baker Hughes was upgraded by Credit Suisse from a neutral to an outperform. You can see it's in this consolidation zone. I do have a PMO buy signal coming in very oversold territory. Scooter is still pretty bad. OBV is still about, it's pretty even, but I like this setup if we can get the breakout. I would look for a move to the 2350-24 level if we get that breakout, but there's certainly a chance that we won't. And in that case, with Baker Hughes, where do we go for more support? Not even on the weekly chart. We have to go to the monthly chart. And the next area of support, if we do break down from that area, is way down here at $15. So something to consider if you wanted to take that chance. I don't know that I would, even though the daily chart looks pretty good. Darden Restaurants was upgraded by two research companies. Let's see, BTIG and Maxim Group. Both of them moved them from neutral or holds into the buy category. So both of them have Darden Restaurants on a buy. I think the chart looks interesting. We're having a lot of trouble holding above this level of support that lines up, with this July low and these lows in October. Trying to pop up through, failed the last 2 days, and today it looks like we may fail again. We popped above it, but we're not closing above it. The PMO is starting to decelerate, so that's interesting, but I'm not looking for this one to do much, even on the upgrade by two. Medtronic was upgraded today by JP Morgan from a neutral to an overweight. Again, these charts, I'm not really a fan going in on these. Right now, you can see we're trying to get a failure here from that rising bottoms trend line. So we're trying to break out of that trend. You could make a case for a double top here coming off of this rise. I don't like it. Then the PMO sell signal, of course, definitely triggers for me that I'm not going to be interested in this. But watch that rising bottoms trend line. If we lose that rising trend, I would look for a drop down to that 88 level where we had that October low and the May high. All right, couple downgrades for you. Kinross Gold. This was Credit Suisse neutral to underperform. Interestingly, this one looks pretty good, even on the downgrade. We're getting a breakout here. We haven't closed yet above that area of resistance, but should we? I think there is that possibility of a move up here all the way into that 350 range. So I think that could be interesting, but we do need to, I would like to see a close above that $3.10 area. And finally, our last one, Micron, as Tom was talking about. Obviously, investors aren't liking what they heard today with the earnings report. We've got trading gapped down from yesterday, completely under support. And then I went into the weekly chart to find some more support. And when you get down to it here, if we miss this $30 range, or we can't hold 32.50, that lines up here with that top in 2017. I would be looking for a move down to that 25, 26 area where you have these two lows back here in 2017. So you need to see it move back up, but you can see it's in a longer term declining trend, not so good. So let's go ahead and look at the ones that I went over and the ones that I did not. Some of the other upgrades you might be interested in was Bed Bath & Beyond, CF Industries, Bloomin' Brands, Hershey, Shake Shack, and Wisdom Tree all were upgraded today. And as far as other downgrades, Analog Devices, American Express, JP Morgan, Schlumberger, Stifel, Under Armour, and Core Labs. So we had quite a few. And then I also wanted to note that JP Morgan must have gone through their REITs, because today they upgraded 11 different REITs and downgraded 7. So might be interesting to take a look at the REITs industry group sector. And that's all I got. So it's time for Danielle to come back. And Danielle, you're from simplertrading.com, and as Tom was talking about, you primarily do options. So we're definitely interested in hearing more about that.
Yes, that's correct. Well, thank you for having me. Let me go ahead and get my screen share going here.
And there you go. Looks good.
Thank you so much. Awesome. So what I'm going to be doing today is a little bit of a mashup. So I'm just going to do a quick presentation just about my trading style overall and myself, so you can get to know me a little bit better. And then I'm going to go ahead and flip over to some live charts and show you some live examples. All right, so first of all, the topic of this presentation is when the switch happens. So as an options trader, I trade on a much shorter term time frame probably than stock traders. I typically will stay in a trade anywhere between about 1 day and probably about 3 weeks at the max. I do have a long-term stock portfolio, but primarily I am an options trader. So I'm a strict technical analyst. I do a lot of Fibonacci, so that's really important as far as my trading strategy is concerned. And I really focus on top-down analysis, just like y'all were doing right there. So I start primarily with the sectors and indexes and then narrow that down to various stocks that I like, and then I trade those on a short-term options basis. So it's just a little bit about me. I used to be an elementary school teacher. That was me 6 years ago, living in Costa Rica. That was my 6th grade class. And then my father got me into options trading. So I went straight from teacher to options trader. And then, now I ended up teaching others how to trade options. So it works for me. I'm really happy that my dad got me into it. And that's what I do now. So as a trend follower, I am primarily a trend follower, but as we know, the market has been pretty volatile lately. So that's why I have incorporated now into this presentation the switch. So just so you know, primarily what I do is trend following, and this is what I call the 5-star setup. It's based on the top-down analysis. Like I said, you start with the indexes, sectors. I work to identify the top 3 sectors, both going to the upside and then to the downside. And so I'm heavily shorting the weaker sectors and long the stronger sectors on an options basis. So all of this analysis is done on the underlying stock charts. And then from there, I work on identifying what is the option, my favorite options play. So primarily in a trending market environment, I focus on the 5-star setup. These are the 5 stars of my setup. Number 1, I work to identify a solid trend. Number 2, the chart must have some underlying Fibonacci analysis that aligns with the trend. Number 3 is going to be a squeeze. So this is my favorite indicator that I use that comes from my primary trading mentor, John Carter. Squeeze is really just a high probability moment in time to jump on a trade. So you're basically just looking to identify consolidation on a chart, and then you want to get in that trade before that consolidation breaks out. And that's how we make money in the options market, because, in options, the only way you're going to make money is if you get in before a greater than expected move. So that is the key right there.
Danielle?
Uh-huh.
A couple things. First, I just want to clarify that you're not talking about a short squeeze, right?
No. So we do trade short squeezes as well. But no. So what this is let me show you. I can show
Is this
you live
where
chart.
you might see the Bollinger Bands narrowing, where you haven't really seen a whole lot of action. You're expecting a much bigger move?
Yes, that's correct. Bollinger Bands and Keltner channels. And this is the way that it populates right here in my Thinkorswim. I use Thinkorswim for my charting, and this is a free tool in Thinkorswim, but basically it is a combination of the Bollinger Bands and the Keltner channels, and it populates by these red dots right here. So what you're doing is you're looking to get into a trade right about during this time before the squeeze fires. When the squeeze turns from red to green, that is when it's firing. So for example, during this time period, I'm getting short Baidu, and then the squeeze fires, and then boom, there it goes to its target. So that is what we call the squeeze. But I do also trade short squeezes to the upside during an uptrending market as well.
And when you get into one of those periods where the stock isn't really doing a whole lot, I'm assuming that as that Bollinger Band narrows and so forth, is it also true that maybe the spread on those options would be less because we're not seeing the same amount of volatility? Is it?
Yes, that's absolutely correct. So you want to get into it before it moves when the volatility is lower, because once it starts to move, I mean, that's the point where you're really chasing, and you don't really have as much of an edge in that moment in time. So yes, that's exactly correct.
Okay, thank you.
Yeah, of course. So pretty much, the majority of my trades are all going to incorporate a squeeze. I will trade just trending charts that have some fib analysis, but especially for options, you really need that explosion in price in order to make money. The fourth thing that you really need is a solid entry point. So you have to get in where you have an edge. This is going to be a sufficient pullback. And I determine that on a technical basis. I like to use, like I said, Fibonacci, and generally about the 34 to the 21 EMA. And then the fifth part, this is the one where it could be a short squeeze. So for example, if I have a ticker, I think MDB was a good one lately, that it has a trend, it has a Fibonacci cluster, there's a daily squeeze, I have a good entry, and then the fifth star is what brings a setup from 4 stars to 5 stars, okay? This is the fundamental backing, or it can be something like a short squeeze. So what that is it's a setup that's a setup in and of itself. Without all of these other 4 factors, it's something that is already a high probability setup. But when you add the 5th factor, that's what brings your setup from good to great. So something like the stock being in a strong sector, just like you were talking about with Pfizer. So, I mean, healthcare has been relatively strong. And we have something where Lilly is very strong as well. So we have a strong stock within a strong sector that are both moving higher. That would qualify as a 5-star setup as long as it has all of the other 4 criteria. So that's primarily what I look for in a trending environment. We do still have some of those in this current environment, but right now what I'm really looking for are the shifts and the trend shifts. So, this year, obviously, we've had a high level of volatility, and we're not in a trend environment right now. So what we need to do is we need to learn how to recognize when the trend shifts. We got to know the formula for the shift. And then the second part, especially when you're a shorter term trader, is, I don't know about you guys, but it's been a lot more volatile and stressful lately. So we have to tame our trade monsters. So that's just really the mental shift that you have to, that you really have to work on to keep your head in the game during this volatile times. So number one, what do we do when the shift happens? Master the technicals. So my favorite tools are going to be the Fibonacci extensions and retracements, the moving averages, and the grab candles. Like I just showed on my live charts right here, and I'll show you some more examples. These were actually created by a colleague of mine, and we give these out for free, but it's just the colors of the candles. So the colors of the candles populate in a specific way based on where they are in relation to the moving averages. And the colors of those candles really help you identify when a trend shift has occurred. So when I say grab candles, that's what I mean. Those colors, those colored red, blue, and green candles. How many of you are familiar with Fibonacci? Do you all do Fibonacci a lot?
We talk about it occasionally on here. I mean, it's not a regular part of the show, but yes, we will pull it up from time to time, especially if it lines up with other technical indicators that we talk about more frequently.
Okay, awesome. Great. Well, I've worked pretty closely with Carolyn Borodin, who's the Fibonacci queen. And so the reason why I love it is just because, stocks are going to ebb and flow, right? And so the best way that I have found for me to measure it is through Fibonacci analysis, particularly measuring symmetry and measuring similarities of prior swings to kind of just determine where I think the market is going from there. So here's just a couple different examples from when the market has shifted this year. This is a S&P futures chart. I primarily reference S&P futures, Dow futures, and Nasdaq futures because I like to look at the charts that include the overnight action. I don't trade a lot of futures, but I usually always start my top-down analysis with the S&P futures chart. So it may look a little different than the SPX cash, but that's really what I use. So if you look at this S&P daily chart, I mean, we all remember these time periods, right, that have happened this year where these shifts in trends have occurred. So if we go back and we look at it through the lens of Fibonacci, we can see that these key reversals came in at key areas of Fibonacci resistance, which come in the form of retracements or extensions. So for example, this last one right here, we had this fall that started in the beginning of October. And in Fibonacci, the 618 and the 786 retracement levels, these are key areas of resistance. And so we always are looking for the market to pause at those points. So when the market traded off the low, it traded directly up into 28.15, boom, and down she goes again. So even though I don't really trade the S&P futures a lot, I'm always looking at this to determine what other trades I want to have on. So for example, if I can see the S&P futures are failing at key resistance on a daily chart, that tells me, all right, well, what other tickers can I look at to short right now? Because if the whole market is headed lower for the next couple days, what I want to do is I want to identify stocks that I can short for the next few days that go with the overall trend of the market. So for example, on this day, that was the beginning of November, the ones that I identified were shorting the spiders, the Hughes, Facebook, as well as Alibaba and the financial stocks, because those were the weaker links while the overall tide was going to the downside. So
Danielle, there was a question that was in the room, so I thought I'd just pass it along to you. And the question said, is buying a put better than shorting a stock since it involves less risk? Do you have any thoughts on that?
So for me, it comes down to really the size of your portfolio. I got into options trading because you can trade options with $10,000, $15,000, $20,000, whereas it may not be as effective to trade stock with low capital like that. So for me, it comes down to really what you have to work with and how much leverage you're willing to have. So when you buy an option and when you buy a put, yes, you do have less risk. I mean, depending on the sizing, of course. So for example, if you wanted to buy a put on Facebook, it would cost you, if you wanted to buy a put on, let's look at one. So let's look at Alibaba. Alibaba is one of the more expensive ones. But if you wanted to buy a put on Alibaba, it'd cost you maybe, let's see, the way I would do it anyways, it would cost you about $10, so $1,000 for one put on Alibaba. That would be about 23 days till expiration. So yes, you could short Alibaba with $1,000, but it is significantly more leverage than stock. So I mean, it just depends, like what what you're willing to risk. So if you short the stock, I mean, it's not going to move nearly as much as the put. Does that all make sense?
Yeah, and maybe to those that are not familiar with options, one contract equals 100 shares. So if they were doing the math on that $10 costing $1,000, they might have a problem. But just remember, one contract gives you the right to buy or sell 100 shares of the stock. So you always take that price times 100.
Yes. Yes. Thank you so much. And so for me, I mean, we do different option strategies, all just buy puts. I like a lot of butterflies. Those are cheaper. I also do credit spreads, debit spreads. There's a variety of option strategies that you can do to make your trades cheaper. But I usually just do this on a very short-term basis too. So generally about, like I said, 1 day to about 3 weeks. So anyhow, going back, I mean, these are just a couple different examples. This is the March correction that was failing at a March correction that failed at a 786 retracement level. So this is why I always start out my analysis with the futures charts. Moving on to a specific stock chart, Alibaba is one that I've been shorting regularly for the past couple months. Previously, Alibaba was one of my favorite 5-star trades to the upside where I would trade these swings higher. But then what happened was when it hit the 211 high, that was right at a 1272 extension level. And the switch happened right about here. So what we have is a combination of price, number one, hitting the 1272 extension. Number two, price falls below the moving averages right here. And the moving averages are now resistance instead of support. Number three, the candle shifted from green to blue to red right about here. And then additionally, you have the entire macro story, right? Because Alibaba is one of the chief Chinese internet stocks. We have trade wars with China. The whole market, the K-Web in China is headed lower. So that is what brings it from a 4 to a 5-star setup, because it has that macro fundamental backing. And the entire K-Web is headed lower, the basket of Chinese internet stocks. So I look for Alibaba to go along with it. So with this one in the options market, I mean, what we do is we look for it to retrace back up to these areas of resistance. Short it here, short it here, short it here, short it here. So like you said before, I mean, you can do that with stock. You can do it by buying puts. With Alibaba, it's more expensive, so I prefer to buy put butterflies on it. It just brings your cost basis down. But that's just basically an example of how I go about that. The Facebook trend shift is, pretty obvious on this one, as we had the break with earnings. But it's the same thing. You just follow the rule set and you identify your trend shift. So just have to remember, these are the 3 key factors that I use: retracements, extensions, price in relation to the moving averages, and then candlesticks. I also like to use, wiki tops, wiki bottoms. The second part of this, and I'm not going to get into this one as much just because I wanted to go over make sure I had some time to go over the live charts, because I am noticing a lot of trend shifts today in particular, even though today is a Fed day. So I do want to be cautious, especially in the options market. You really don't want to be super leveraged before a major Fed decision because things can change very quickly. So the second part of this is just learning how to tame your trade monster, because especially in volatility, it can be especially difficult to sit through the ups and downs. So your trade monster is basically the part of you that escapes when you let it, causes you to lose money in trading based on improper decisions that you make. you're being too emotional, doing things like this. You're buying without a setup. You're buying at the highs. You don't have risk management. You have extreme euphoria. You're bragging about your trades. You're forgetting that Mr. Market's in charge, not you. You're forgetting that you don't know what's going to happen next. Anybody experienced any of these feelings before?
No, I don't know what you're talking about, Danielle.
I was going to say, is that rhetorical?
Yes. And, absolutely. I have times where I know I need to tame my trade monster, and, I'm getting a little bit too excited, getting a little bit too clicky with the mouse. And that's when you really need to pull back, understand you got to tame your trade monster, and follow these steps. You have to work on your focus, work on your emotions, and work on self-improvement. So I have a whole, presentation about how I do those, but I did want to make sure that I have time to go through the live charts with you. So, basically when it comes down to it, I've had different time periods in my life that have been much worse than others as far as trading is concerned. I think the one of the craziest times for me was last January, actually, because as a directional options trader, I just got so euphoric last year, 2017, January 2018, with the market just trading straight up, right? You get so used to making money every day and feeling like, oh, nothing bad is ever going to happen and the market's going to go straight up forever. And then, of course, what happens, right? You have a January correction. So always want to make sure that we're sticking with trading plan, working to manage emotions, and sticking with technical setups. So let's go ahead and go over to the live charts.
When you buy these options, are you typically looking for in the money options or out of the money options, and what's your rationale there?
So, yes, primarily always in the money options generally, because in the money options are going to hold their value a lot better than out of the money options. They are more expensive, but they hold their value better. So right now, with the market environment that we're in, because of the high volatility, it's actually a lot better to do things like buy butterflies or sell credit spreads in the options market. Buying options right now is a little bit more difficult, just because the volatility is so high that increases the price of the options, and because of the volatility, it's a lot more difficult for anybody who's not accustomed to trading options to sit through the swings, because the swings have been rather violent. Mm-hmm. So right now I'm focusing more on butterflies and spreads. But, right now, what I'm noticing in the markets is just that I have, and, very similar to what all of you were saying before I got on, is that we have a lot of oversold buys coming up. So here's the S&P futures. Here's my area of support at 25.15. And I'm noticing this is another indicator that I use. It's called the Ready Aim Fire, but I also use the VZO volume zone oscillator. These are just two different indicators that I use that determine when a good shift is happening. So for me, and keep in mind, all of this needs to be reevaluated if there's a crazy Fed decision. But as of right now, I'm looking at a shift in pattern. I've got the S&Ps that have now sold off for a little over a week and a half, came down to primary support, and we're trading off of the lows. So what this tells me is that the larger overall basket, and I like to go down to a lower time frame chart as well, because you can see the shift happening here, especially with the colors of the candles. Let's go ahead and erase that one. So you see how the candles are going from red to blue to green. And you also have, obviously, your low holding. This is a moving average cross right here, 830. I use the 8 and 34 exponential moving averages. that are crossing right about here that tell me that a larger trend shift is taking place, and it's starting out on the lower time frame charts. And ideally, that'll bleed into the larger daily chart, and we can get a few day rally in the S&Ps that I could potentially trade higher in a couple of these key stocks. The other sectors that I'm looking at for an oversold buy, and keep in mind, like, as a trend follower, I hate counter trend trades, but this is what I'm seeing right now, and I'm looking for money flow going in and out of varying sectors and where the next area of money flow may be. So with XLF financials, of course, these have been just completely hammered, right? But I have a key area of support. I have reversal signals, and it looks like at least we could trade it back up into the mean. Financials, industrials, and industrials, and transports. I mean, these have really been weighing heavily on the markets with their downtrend, and you can see where the shift in pattern happened right here. And at this point, it is, for me, a counter trend buy back up at least to the mean. Now, just because the shift is happening, it doesn't mean that it's going to, magically turn around and turn back into a bullish pattern. But at the very least, what I'm looking for on all of these charts, starting out with industrials, financials, and transports, is I'm looking for the first signs of a shift. And if, which is a big if, because the market's very bearish right now, if we can breach through these final areas of resistance and resume a bullish trend, that is what I want to see. So IYT is the next one I like to look at. I like to look at IYT, the ETF, the transportation ETF. This one really leads the market to tell you, which direction the overall market's going. And I'm seeing the first little signs of a possible reversal back up here. Going on down to specific charts. So for example, like I'll start with the Nasdaq, right? So the Nasdaq has been stronger than the S&Ps. And then I look for relative strength buys within the Nasdaq. So we're starting to see the Nasdaq hold off of support, just barely, right? It's just starting. And you can see that on the lower time frame charts here. You can see the little shift coming through. But then that leads me to key players within the Nasdaq. So Microsoft is one of my favorites. And I had yesterday a key area of support on Microsoft at 101.69 to 102.29 that hit and held perfectly. And now today it's trading off of that area of support, which you can see through the lower time frame chart.
Hey, Danielle.
Uh-huh.
There was a question in the room that was asking how you find what scans do you use to find candidates? I know you just went from the Nasdaq, which you said was a relative outperformer, and then you found Microsoft. But how do you actually make that move from Nasdaq to Microsoft? Is it based solely on Microsoft's chart, or is it their relative performance to that index that you're using? How do you scan to drop down to those individual stock candidates?
Yeah, sure. So let me get that out of there real quick.
And I don't want to cut into your presentation, but we do have the questions, and we can always...
No, it's okay. I love the questions.
Yeah, we'll definitely have you back, and obviously we can cover some other things in the future, but I just wanted to throw that question out there.
Sure. So there's two different ways that I answer that. So first of all, this is my process that I do every day. And so it's gotten second nature to me. So I'll try to explain it. But what I do is basically, this is one of the free websites that I use, sectorspider.com. And here are the 11 sectors within the S&Ps. So I just did that whole analysis very, very quickly for you. But what I do in my market research is I start by running my fibs on all of these charts, okay? Communication sector, discretionary, staples, energy. And then through that, I identify which sectors that I like for a buy and which sectors I like for a sell. So that's the first step. So I do the S&Ps, NASDAQ, Dow. NASDAQ's my favorite because it has because of the technical levels. Like the S&P has given back all of its gains on the year. Nasdaq has gotten hammered, but it is relatively stronger than the S&Ps. It's still up on the year. And then I go down to the sectors. So I run my fibs on the sectors. So for example, like healthcare is one of them. So I've been focused more, and Johnson & Johnson obviously was not helpful to healthcare last week. But I run my fibs on the overall sector. So I do have a buy point on the healthcare sector right here, which is 85.75 to 86. And so what I'm looking for is a shift in trend in the overall sector. And then I say, okay, well, there we go. We've got our trend shift coming in. Okay, great. Now let me go back to my sectorspider.com and say, and I know all of these by now, but you just go in here and you say, okay, well, let's look at the stocks within the healthcare sector. What are they? All right, well, here you go. These are your top 10. So I start off with these. And so then I go through and I say, okay, well, I know Johnson & Johnson got creamed, so we're not going to look at that. And then I go through the list and I run my fibs on these charts, and I'm looking for that filter of I want the trend, I need fib analysis, I want a squeeze, which leads me to Unitedhealthcare. So I have in Unitedhealthcare, number one, it's in one of the stronger sectors, and healthcare is kind of bipartisan, right? So it's like, well, I don't think it'll be too affected by anything that Trump is doing. If anything, it will have a positive impact because now we have the divided Congress. So the probability of him repealing the Affordable Care Act and all that is higher. So then I say, okay, well, what stock do I like? Okay, I found Unitedhealthcare. I've got a weekly squeeze. So a weekly squeeze is huge. When you have something that's consolidating on a weekly chart, generally the daily chart's going to look pretty sloppy, but that's okay because I'm looking to trade it on a longer term basis. I have a weekly squeeze that tells me it's consolidating. I have a key area of support that comes in at 250 that can give me a good stop loss point. And I have earnings coming up in January. So typically, historically, you're going to see a run into earnings anyways on something like this. And you have a weekly squeeze. So like, look at this last weekly squeeze right here. Here's one right here. So you see how you have those red dots and then it changes to green? That's when the squeeze fires. So you want to be in the trade when it's in a squeeze, waiting until it fires. Here, here, and now you've got another one here. So that's what I'm looking to do on that. So that's how I identify them. I just do that whole process. I start with sectors, then I pick the stock. The other thing that I do is I have scans. So the scan that I like to use is, this is what it is. I'm basically looking for stocks that are at least $50. I'm looking for stocks that are within 10% of the 252 period high. And the reason for that is because I'm looking for the best in breed. I'm looking for the strongest stocks in the market that I can trade on an aggressive basis with options. So you're just trying to trade them for like 2 weeks. And that leads me to a couple of these, like O'Reilly is one of my favorites right now. So O'Reilly's consolidating into a weekly squeeze, but I really like it because it has this daily squeeze. So if you look at it on the daily chart, it is a little sloppy, but that's because, it's consolidating on the weekly chart. So we have a signal right here. Here was the last signal that we got. And it's holding up on that 50 period simple. I've got a buy signal there. I've got a target of 372. So for something like that, I could just set up a bullish butterfly on it for a target of about 370. or just sell some premium on it. And then, of course, you know, you can always just trade the stock as well. But the auto parts makers have been doing very well in this market, while you see things like auto sellers just continually trending down. So I continue to like these for a 5-star setup, even with the volatility of this market. I mean, you can see that it's held up really well relatively. You can see that by the fact that it's held the 100 period simple. This is the 100 period simple right here. Sorry, I keep forgetting you guys don't know what my indicators are. And then this one is a 200 period simple. So most tickers, you know, have had a decline like at least 20% or more, a large variety of them in the S&Ps, and this has a lot of relative strength. So I like that. A couple other ones are Starbucks.
Yeah, we probably have another minute or so, or minute, 2 minutes. I do want to have time to bring the poll up so we can talk about that. And
yeah, sure. Go for it. Let me, whatever you like me to do.
Go ahead and finish on your Starbucks if you have one more that you know, that you really like. I think our audience would love to hear that.
Yeah, sure. So mainly right now, I like Microsoft. This is the larger list that I have, the larger scan list. AMT is one of my favorites right now. CME looks really good. McDonald's, O'Reilly, Starbucks. And then, you know, most of these I would just look at it to trade on a shorter term options basis. But Microsoft in particular, Microsoft and Unitedhealthcare are two of my favorites. Microsoft has a history of running up into earnings. So as an options trader, this is something that we can take advantage of in the options market, because options premium increases going into an earnings report. So one of our favorite trades that we like to do is buy options on Microsoft about 3 to 4 weeks prior to earnings, and then take advantage of that rise into the earnings report. And then we like to sell our options directly before the report. So that's one trade that I like to do there. And I'm going to start getting into that one pretty soon. But I also do hold Microsoft stock. So I'm looking for a price target. I'm looking for a price target on Microsoft of about 120. Because I also have the consolidation on the weekly chart that I'm looking for that to break out. And I'm looking to trade that into about 120. It's had a little trouble at the 112 price point, but 120 looks like a good target for me going into the next earnings report.
All right, I do have maybe one final question for you. And you just said that you would get out before earnings. Is that, do you always get out before earnings if you're holding options?
Yes, because what happens is the IV crush comes. So basically what happens as far as options are concerned is you can buy options in advance of an earnings date at a normal price. Okay, like for right now, this Unitedhealthcare, the date of earnings is January 14th. So what happens in the options market is the price of the options are going to increase going into that earnings date. The reason why is because that's volatility. So the earnings date brings volatility. And we know that as a fact, options prices increase going into earnings. That's just what happens. So you buy them prior to earnings, it increases going into earnings. But what happens is it gets to about the max point directly before the earnings report. So usually I trade the close in our trading room, and I will get out of those positions literally like 15 minutes before market close when the earnings report is that day. Because what happens is the price of those options increases. It goes up, 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 up. And then after the report, because they're increasing in anticipation of the report, after the report, they go down back to their normal price that they were 3 or 4 weeks ago, because that event is now over. So if you don't sell your options before the earnings report, you will get hit by what we call the IV crush, the implied volatility crush. that will basically cream your options. So a lot of inexperienced options traders will come in and think it's a good idea to buy an option on a stock right before the earnings report. And that's another reason why it pushes them higher going into the earnings report. But that strategy really just doesn't work. So we try to take advantage of the pre-run.
Okay. Well, we are going to have to move on, but tell you, this has been a very enlightening discussion, and I know we're going to want to have you come back in the future if you've got some time.
Excellent.
But here is the poll that we had everyone take today, and it says 43% have never traded options. And before the show, I think you were saying that you just kind of went straight to options. You didn't really trade stocks. You went straight into options. Is that correct?
Yes, that's correct. My dad got me straight into trading options, and it's really just now that I started building a stock portfolio, actually 6 years later. So
Funny. That's a little different than probably what most people
yes.
Stock market. But anyhow, it was a real pleasure having you on here, Danielle, and I hope, first of all, you have a great holiday at the end of this year, and Happy New Year, and come back and join us soon.
Thank you so much.
All right, there she
Excellent.
goes. Yes, Danielle Shay. Awesome. And again, Erin, I don't think we've really had much discussion in the past about options. I know we've had questions, but it's good having someone on here who does this regularly.
Right, because I know I wouldn't want to get out there with as little as I do with options, trying to teach everybody, all of our viewers. I'm not going to do that. So,
yep. Well, I think we need to get rolling here because we got 10 and 10 and get that final segment. So I'm going to go. I'm going to go fast.
Oh yeah. Okay. I can do that for you.
All right. I am going to jump right in first to our first stock, which is wheat and precious metals. I will say that the dollar a few days ago I thought was topping, has been pulling back. I had mentioned earlier in the week, for once, I actually liked gold. GLD, gold has been rising, looks pretty good. But here, I think this is a really nice character change on the chart. Big volume. I would suspect on any pullback, $18.40 to about $19. I think in this range, you can see that also lined up with support back earlier in 2018. I think that would be a key area of support to watch.
Okay, let's see. The most popular in the chat room, and I think we have talked a little bit about it, but gold, GLD.
Yeah, just mentioned it. I think this breakout's pretty substantial, and I love the break of the trend back to the upside and holding the rising 20-day on this latest pullback right here. So that, to me, is a pretty good sign. The last time we broke out, you can see it was really a messy breakout. This time we break out, we hold the 20 and rise again. PPO looks good. I think gold looks good right now. I would not have a problem owning gold, especially as long as that rising 20-day continues to hold. All
righty. Let's see, next up, we haven't looked at Tesla in a while.
Yeah, I think on a longer term chart, this is one that, it's pulled back here recently, but that's not shocking because we're at a major area of resistance. I'm going to pull up a weekly chart, and let's go back, I think 5 years should do it. And you can see clearly coming across just around 380 or just above 380. That's where sellers have been lined up really for the last 18 months. So not shocking that recently we get up to 380, almost to that resistance level, and back down we go. But I think that Tesla's looking pretty good here. And so on this longer term chart, I think the last pullback held above the 20. This one so far is above the 20. The 20 is crossed back up above the 50-week moving average. I would look for this to hold, and a breakout above, say, 385, 390 would be very bullish for Tesla.
All right, excellent. Next one up for our friends in Canada, the only financial one requested, and this is a long symbol, so be ready. It is CUF/UN.TO. All
right. Yeah, big move, very, very heavy volume on this push to the upside. We were in a downtrend, but when I see a break of trend like this, I want to see the volume coming in. We certainly have that. I would look to the downside 2 areas on a pullback because I like to buy pullbacks. I would be looking first. Well, actually, first I would be looking at that rising 20-day moving average because if we truly are uptrending, I would think we'll see some buyers come in on that first test. So 1150-ish. But even below that, if we did go down below the 20 temporarily, maybe even just on an intraday basis, I think 1130 price support will hold. So this is a stock that to me looks pretty good. Again, I think this is a change of character, and I would expect higher prices ahead.
All right. Let's see, next one I'm going to give you is Lockheed Martin, LMT.
Yeah, downtrending stock. We got a little bit of a descending triangle off of the downtrend, so it's not looking very good overall. I think there are probably other trades in this space that are going to be better. Clearly, there's your downtrend. The support, which initially, at least on a candle body basis, was there. I think now we could go down to that low in December. So this is an area of support. You can see the last 3 days we're trying to bounce off this area. But even if we make a bounce, we got a lot of work to do technically. We got to get back through the 20 and eventually break back up above these reaction highs. So a lot of work. I think there are many stocks out there look better right now. I would avoid it.
All right, let's see. Next one up is going to be EPI, and that is the Wisdom Tree India Earnings Fund.
Yeah, I mean, I like the breakout. I'm going to go just a little bit further back. Let's take it back a year because it looks to me like a pretty significant area. Yeah, this is a pretty big area that we're breaking out from right now. So if you were interested and this is an ETF that you're looking at, then yeah, I think this breakout looks pretty nice. What would get me out of it if I got in, because I believe that we're breaking out, we should be trending higher. So to the downside, I think we should hold this 20-day moving average on any pullback. So I like the breakout. This was a key area of support. That becomes resistance on the next move up, which we saw. We pulled back, we held that prior low, and now we're breaking out to a new high. So I do think this one looks good. Keep the stop in play below the 20-day.
Okay. Next one up is going to be Intel. I know we talked about Micron, but what do you think of Intel?
Yeah, Intel is doing much better than Micron. I would say that, Micron, Applied Materials, some of those companies have done much worse on a relative basis than Intel. And yesterday when I was looking at the Dow stocks, I actually said that Intel to me is one of what I would consider like a swing stock in the Dow, helping us decide whether or not the Dow is going to break down below that February low. I think this is one of a handful, maybe 7 or 8 stocks in the Dow that I need to see which way we go here. Breakout above 50 and a quarter, I think would be very bullish, but a breakdown back below 46 would be bearish. We're sitting in the middle of it right now, still waiting on a signal. So I would sit on my hands.
Okay, next one up. And this one apparently came up on my dog's scan back in August. Bristol Myers, BMY.
All right, BMY.
So it came up for a short mid-August. So it took a little while, but it did eventually fall.
Yeah, and this is one, again, you've got a great pharma group, and then look at what this stock's been doing. So on a relative basis, Bristol Myers is one of the worst performers. These are the kinds of stocks that I would not take, especially if I've got a hot group that's performing really well relative to the S&P 500 like the pharmas have. Why not go with the best stocks within that group? Why try to catch a bottom in a stock that's underperforming? I think the market is telling us something. So I think we've got some really good support down at about 47, maybe just below 47, up to about 49 off of all this selling. That's where the buyers came in, but I think it's pretty clear that gap resistance was major resistance. There was your false breakout. We failed to close above resistance, and now we're sideways consolidating. I think we're going to go back to that 49 area and possibly a little bit lower. So this is not the pharma I'd be looking at.
Okay, and let's do Macy's. That one probably is getting some business right now.
Yeah, Macy's, they might be getting business, but right now the market's not liking them. You can see, first of all, broadline retailers are declining finally. You can see Macy's relative to the group after a spike back a couple months ago, now trending lower. I think this one comes down to, and let me draw a trend line, a support line. Coming across here where you've got the gap from very, very heavy volume, or a gap from a huge volume move higher back with earnings in May. You can see that they pulled back. That's where the buyers finally, said, hey, this is where we're going to really support the stock. And when you come across here, notice we're trying to bounce off of this area. I think if you go back down below the lows that we just saw a couple of days ago, I think we're probably going to go down perhaps, somewhere into this 28, maybe even as far as 26 and change, somewhere down here. I think that would add a certain level of bearishness here. So for me right now, I would stay either in cash looking for something else. If I did get into Macy's, then it needs to be a fairly tight stop.
All right, and our final one, our only consumer staple, New Age Beverages, NBev.
Yeah, New Age Beverage, I think, was acquired. I never went back and looked, but I think they were acquired by another company. The stock is definitely trending back higher. And the big thing with this stock is that now that it has started to trend higher, it's acting like it's in an uptrend. So, for instance, the 20-day, I talk about this all the time, but once you break above, if you're truly breaking this downtrend and beginning to uptrend, you should see these pullbacks to the 20-day hold. So far, it's holding. I think if we get another one, that's where I would be looking. The recent price low just in the past few days, right at about 5.25, and that's just right where that 20-day moving average is. So that would be what I would look for if we got a volatile sell-off for a day or two here in the stock.
All right, that's it. You did it. Completed the 10 and 10. And here are the symbols we just covered. I will have those up in the Market Watchers Live chart list. Just go to the blogs tab, click on the Market Watchers Live blog, and the link is right there at the top. All right, let's get going on our final market update. All righty, here we go. Got it all together, making sure we're good. All right, as you can see, I mean, we're trending higher on the S&P and on the Dow. I think that's good, but it does look like we are pulling back a little bit. We'll have to see if that rising trend can continue. A small double top on the Nasdaq right now. Looks like it could go back toward today's open or yesterday's close. You could see S&P 400 also trending higher, Russell 2000 same. TSX still hanging around its intraday highs, so I'll have to see if we can break through there. Treasury yields are down, reading 2.817%. The VIX is falling. We now have a reading just under 24 of 23.86. UUP, big gap down, but consolidating sideways. Gold had a nice move on the upside at the beginning of the day, but is now pulling back towards yesterday's close. GLD is at 118.44. USO is actually up. Looks like it's finally broken its declining trend here. So we'll see if that can continue and if it can hold on to that. USO is at $10.08. TLT rising nicely, currently 120.23. And that's all I have for the final market update.
All right, I just wanted to, again, point out on the S&P 500, I'm not shocked that we are struggling here up near this level. This is an hourly chart, and when we are moving lower with the PPO and setting these lows, it's not unusual to go up and test that 20-hour EMA. You can see intra-hour, just last hour, we went above it. We got up to 25.78. If you remember, the breakdown in the S&P 500 was below that February closing low at 25.81. So off of the 25.30 low that we saw on this double bottom, we've come back up to a key area of resistance, trying to get through the 20-hour, trying to get through that 25.81 resistance area, and we're setting up perfectly here in an hour, less than an hour for the Fed announcement. I'm not sure where we're going. We're very oversold. Maybe we get that relief rally and perhaps make this break. But even if we do, I would then be looking probably onto maybe a daily chart on the S&P 500 and maybe looking up to the declining 20-day moving average. I doubt that we're going to see a move back up through that, which is at 26.48. If we do, I think that'd be a great sign for the market, especially if we get some volume coming in. But my guess is that even if the Fed, we get a little bit of a relief rally, I would think maybe that 20-day moving average might present some obstacles for the bulls.
All right.
All right. We got about 11, 12 minutes here. Final segment, sector rotation. What do you have?
All right, I'm on it. Started with the relative rotation graph for all of the sectors just to see where the health was, which sector I might be interested in looking at more closely. And, obviously the defensive sectors are doing very well. Some of them are starting to turn a little bit, the staples and certainly healthcare. But utilities are still pretty strong, even though turning back down. And obviously REITs, XLRE, the real estate sector doing well. But what I wanted to look at were those Northeast directional movers. And the two that caught my eye, of course, were XLB materials and XLC. And even though XLC is showing a red tail, it is actually in the improving category. So I thought I'd concentrate on those, but I wanted to look at what they looked like on the daily RRG. So I updated it, and materials look okay, to look at. But honestly, the one that looks the most interesting, I would say, is XLC, because it is moving in the very short term. It's now leading and moving in the right direction. So I'm like, okay, now I'm going to go check the communication services sector. So how do I do that? I went into the sector summary, and I'm going to show you how you can get to that very quickly. You just go to your Pro Control Center and click down to the sector summary. It's going to tell you all of the sectors and how they're doing. I checked it for, I wanted to look at 1 month. I think that was one that I did. And comm services was still up there, but obviously in the last month we haven't seen much goodness come from that. And there you go, materials. But all of these have been suffering for the past week. But I wanted to concentrate on XLC, right? So I just go to that summary and I click on the communications. And now I have all of the industry groups that are within that. And I want to check, because that weekly RRG looked good, and even the short term, I just wanted to take a peek and see where the business is as far as that sector is concerned. And internet looks like it is the strongest. Over the past month, up over 3%. And then when I look at the last week, there we go. While it did have a bit of a problem here, you can come down even to the shorter term, and we can see that it is leading as of end of day. So there were a few ways I looked at it, but I decided I'd concentrate on the internet industry. So if you click on it, oh my goodness, look, you get all of those stocks that are in that sector. And we can now organize them by scooter, by close, however we want to do it. So I decided I would do it by, actually, I want to look at my candle glance. So I'm going to try, well, no, let's just do it this way. We don't have the time. I want to do that. So which ones are the bigger big scooter numbers? Which ones are in the hot zone? Well, we can see TripAdvisor, Interactive. There's quite a few, but I like to go for some of these mid-range ones to look at. So NetEase, I know we talked about that one yesterday. I think I'll look at that just to see what's happening. Now we are in a rising trend here, you can see, for NetEase. But the PMO is saying, I don't know. It's starting to decelerate above the signal line. So we could see something very similar to the late November move on the PMO. So while I'm not thrilled with that configuration, I know that, excuse me, I know it is not overbought yet. I would consider this just on a watch list, just to see if we can continue into that rising trend. Because right now we're hitting that resistance at that 200-day EMA, as well as those November tops. So I'd want to see us get through those. What other ones looked interesting? Let's see, eVestnet, ENV. All right, low volume one. A little more interesting, though, as far as the PMO. It is trending higher. Notice the rising bottoms on the PMO and pretty much flat bottoms on the prices. And, when you look at this, the first thought, of course, I know when I would peek at this one would be, I would be looking at this as a double bottom, right? Coming off of this big decline. Well, we came up, didn't actually get to the confirmation line, failed there, and have come right back down. So now what I would do is watch for a triple bottom. And the PMO is getting ready to turn up. So I think this one, ENV, would be interesting for a watch list. And let's look at just one more, and I'll pass it to you, Tom. GoDaddy, GDDY. Now this one, look at even better, right? We have a PMO that has been rising with the price bottoms, and now it has given us what I call a bull kiss, kissed that signal line, and now are heading back up. And I'm looking in that thumbnail, and we haven't quite gotten above that declining trend in the short term. So technically, we're still in a declining trend. 50 just crossed below the 200. So you have to be careful with these, especially in a bear market. But this one is set up a little bit better than some of the others, and also I think worthy to go on a watch list. All right, I think I have time for just one more. I'm going to look at Alphabet, one of our FANG stocks. Very interesting setup now on Google. We had rising bottoms on the PMO and flat to declining on the price, and we got the nice rally off of that. And even though we moved into this declining trend, the PMO just flattened out. We didn't really lose that much in the way of momentum. So now I would be looking at the next area of resistance, well, probably that 50-day EMA 200, but maybe setting up here for that triple bottom like we had on the other, or even in the double bottom. But we just have to get up here to this confirmation line and see if we can't get through that. So again, maybe one for the watch list to keep an eye on. So Google. And those were the ones I had. So I'll pass it back to you, Tom. What do you have for us?
Okay, I was just going to start with the fact, and probably those of you who've been watching the various indices realizes that small caps were among the first to really take a tumble. Starting at the end of August, early September, we began to fall. We saw, the overall market begin to fall in October, crude oil in October, the banks falling off the table. But really, small caps were one of the first to give us a signal. And you can see that the Russell 2000 back in September was at 1740, and at yesterday's low was down below 1380 that we just marked. I mean, that's a really big move, and it's more than 20%. It is a bear market type of a drop on the Russell 2000. And so what I wanted to do is take that in addition to, and one of the reasons I really liked small caps, and I know September and even into early October, this was a rough period for me in my trading because I was trading a lot of small caps, believing that they would do well on a relative basis because of the dollar. And so I'm going to go over to the dollar chart. This is actually the U.S. 10-year Treasury yield versus Germany. And then we've got the dollar index down below. But as we keep rising, as the U.S. Treasury yields keep rising versus Germany, that's telling us that our economy is stronger than Germany's, which many times will result in a strengthening dollar. So our currency is going to be impacted by that. And so this whole chart goes back 10 years, and it does show that the correlation is very strong between the direction of the dollar versus the direction of our treasury yields versus Germany's treasury yields. But what I've seen here recently, just over the last couple of months, you can see this starting to roll back over. And this is kind of playing into just about everything else that we've seen in the past 2 or 3 months, where it just seems like out of nowhere, we saw crude oil, $77 a barrel. Now it's 46. We saw the Russell 2000, 1740. Now it's 1380. Railroads were leading, and now all of a sudden railroads are struggling. So a lot of these stories that are playing out make a lot of sense. And we're starting to now see it in the treasury market with the U.S. Treasury yield dropping, and that could present trouble for the dollar. Now, I say that because, again, if the dollar is strengthening, that normally means our economy is stronger than foreign markets, and as a result, our small cap stocks should do pretty well because they're mostly based right here in the U.S. and do most of their business in the U.S. Well, the dollar topped on the UUP. You can see this black candle off of an uptrend, had higher prices, lower PPO, and then we had the gap down, leaving it up on an island, and we've seen the dollar falling the last 3 days. And this was one of the reasons why I mentioned earlier, I think gold looks pretty good, because if the dollar is starting to roll over, that is going to set up tailwinds for gold. But part of the problem, and this is where some of the rotation comes in, if you take a look, this is the PSCT, which is the Invesco S&P Small Cap Information Technology ETF, divided by the technology ETF, the XLK. So it's small cap technology versus larger cap technology. And you can see back in July, this topped, multiple tops, and it has been rolling over. But it doesn't stop there. Well, let's take a look at the financials. And all of these are going to be small cap versus large cap. Financials probably have held up as well as any group. Now, the overall financial group is down. So when you see that this is starting to point back up, this doesn't mean that small cap financials are doing well. It means that they're doing better than the large cap. So they're not falling as far. But still, we are down below that prior high. Let's take a look at some of these other areas, though. How about industrials? Small caps versus large cap. Right about in August, near that, when the Russell 2000 started moving lower, you can see small cap industrials really struggling. The discretionary, look at small caps topping and breaking to new lows. Then we've got healthcare. And I remember talking about healthcare quite a bit, how strong small cap healthcare stocks were. Look at this double top, and look at what's happening now to the small cap healthcare stocks. Complete underperformance. Energy. PSCE versus the XLE. Yeah, energy's been getting hit hard. Small caps are getting crushed relative to the larger cap XLE. PSCM, which is materials, compared to the XLB, same thing. Topped in September. I mean, you can see all of these are literally just falling off the table. And that's telling me that we've got a lot of problems domestically that the market is just now realizing. Here are your consumer staples. And the last one, utilities, PSCU versus the XLU. And again, the last 2 or 3 months completely falling off the table. So as we go into this Fed meeting, and we can bring up the summary slide, as we go into this Fed meeting, I think things are really setting up, what the market is telling me and what the market should be telling the Fed is that forget about your forecast about 2019 and all these rate hikes that you're expecting. The market is saying that things have really slowed down. And we're starting to see that with some warnings, like we talked about the open of the show with Fedex. They're seeing weakness not just here in the U.S., but also in Europe. And we're seeing a number of companies, many of the banks, falling apart. These are signs that the Fed, hopefully, will be taken into account when we hear from them in about 35 minutes or so. So there you have it. A couple of different ways to look at the whole, sector rotation thing. I kind of took a look at it more from a bigger picture view, and you kind of narrowed down in, and well done. But it's going to be an interesting market here in about 35 minutes.
Indeed. I continue to watch it here as it's moving lower, and those rising trends are certainly in jeopardy.
Yep, things continue to move lower. I do want to tell everybody later today at 4:30, so in about 3 hours, I am going to be doing a 2019 stock market forecast. I'll be doing that with John Hopkins over at earningsbeats.com. If you are interested, it is a free event. But here on the Earnings Beats, you go to earningsbeats.com, and right at the top, you will see 2019 market forecast. You do need to register for this event. It's today, 4:30 p.m. At the bottom, simply put your name and email in, save your seat. And I'll tell you this, there is a problem with capacity. I'm sure we're going to go beyond the capacity of the room. So if you are interested in attending and you want to be there for the live presentation, I would get in the room pretty early, like right after 4 o'clock. I think the room opens at 4, because at 4:30, I have a feeling we're going to be at capacity. And John told me that there will be a recording that he'll send out to anybody that registers, so you don't physically have to be there. But I would suggest you get over to earningsbeats.com, click on that 2019 market forecast, come to this page, and sign up. Again,
Yes.
Start at 4:30 today.
Hey, you know what? We tried to go through the whole show without mentioning our holiday special on stock charts. If you renew for 12 months, you're going to get 2 months free. Or if you buy a nice holiday gift of a 1-year subscription, they will get 2 months for free. So something to consider.
Absolutely. We can already see the market pulling back. You wonder what's going to happen, when we get the word from the Fed. See right now, Dow up 0.81 and so forth. But we'll have to kind of watch it for you. And, of course, we'll be back here tomorrow and kind of walk you through everything and take a look and see where the market is. I honestly don't know where we're going to be 24 hours from now. It should be rather interesting. I do want to thank everybody for stopping by. Special thank you to Danielle Shay for stopping by and giving us some information on options. Please remember to complete the survey as you exit. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Wednesday afternoon, everybody. Put your seatbelt on, crash helmet, Fed coming up at 2. We'll see you back here tomorrow. Happy trading.